Morena. Good morning, everyone. It's welcome to the monthly webinar. It's Stuart Williams speaking. I'm the MD of Nikko Asset Management and your host for the call. Um, yeah, thanks for joining us. Thank you very much for your support. Today we've only got two speakers, bit of a departure, so we may give you back a little bit of time at the end of the day. So we've got Frank Downing from ARC, who's Director of Research at the area of expertise in Next Gen Internet, and Maisie Ho, who I'm sure all of you will know from the New Zealand Equity team. Um, as a reminder, you can ask us questions. So in the Q&A tab on Zoom, if you type in a question, then I'll ask the speakers. Just to set the scene a little bit before handing over to the experts, I'll just do a quick round the houses in terms of the big building blocks that are, I think, important for clients just now. And I guess the most important one is, what's happening with rates. And so when we look around the world, we see the US, we see Canada, we see the Eurozone, and we see New Zealand all cutting rates. We see the same in China, but in China, we also see, I guess, wider stimulus being deployed now as they try and get that economy out of the mire that it's in. The obvious, or if you put Japan aside, who's actually going in the other direction, but I guess the other obvious difference is what's happening in Australia. So in Australia, economic activity continues to improve, but it's improving at a lessening rate, and it's actually narrowing. So they're still seeing employment growth. At the same time, CPI is coming back into the band, but it does leave Australia or the RBA in a slightly weird and perilous position as potentially the last developed market bank not to be cutting. So at the moment, they're forecast to cut in February, and maybe that comes a little earlier. Just to finish off on rates and think a bit about New Zealand. I mean, the history is very clear about what the first rate cuts mean for our local equities market. So if you look at numbers from 2003, 15 and 19, then we see, really strong correlation to positive returns in the following 6 and 12 months. So I think the numbers on average are about a 16% return in the 6 months following the first cut and about a 27% return post in the 12 months that follow. And why is that? That's because it leads to economic activity, but more importantly, perhaps initially leads to an increase in confidence. And then just one final point before handing over to Frank is just think a little bit about the US. So in the US, I guess if there is a soft landing, then that's generally probably supportive of the Democrats. And maybe there's not a lot of policy to us from afar looking at it, but the policy that is being announced is compressing or trying to attract the middle voters, those who can be influenced still. So with that said, I'll go to you, Frank, and perhaps it's a couple of years since we've heard from you. So take your time and introduce yourself. And yeah, thank you very much for supporting us, and we look forward to hearing from you. Thank you.
Sure thing. I'll give a little bit of background about myself and then dive into kind of the presentation to highlight some of our latest research. But I'm Frank. I've been with ARC for about 3.5 years. I'm a research director on the investment team focused on all things artificial intelligence, cloud computing, the semiconductor supply chain that supports that, and oversee some of our work on digital wallets and public blockchains as well. Before coming to ARC, I actually worked in a technical capacity. So I was a cloud engineer. I worked with companies like Meta back when they were called Facebook and Cloudflare, working with their infrastructure departments to help scale their global data center networks. So I spent a lot of time in software development and data engineering that transitioned into this coverage and research and investment that I lead at ARC. I also live in the Florida at the ARC headquarters in St. Petersburg, and there's a hurricane currently going through our town. So if I randomly drop off the call, it's probably because I've lost power. So hopefully we can get through this presentation without that happening, but just giving a fair warning in case it does. So with that, let me share my screen and dive right in here. Can you see the presentation okay?
Yes, yeah, yeah, we can. That's great. Thank
Okay,
you.
perfect. So this is a presentation that I actually just gave at the Nikko Forward conference in Singapore last month. So some fresh and exciting topics here, but it really focuses on two of the five innovation platforms that we base our research on that we think could have some of the largest opportunities for value accrual in the disruptive innovation space. And I'll start with artificial intelligence because, of course, that's what everybody's talking about and thinking about. And artificial intelligence isn't new to us at ARC. We've been researching it for over 10 years since the company was founded. And the original focus of our research, and still a core part of it, was on applied artificial intelligence into domains like artificial intelligence and robotics. And I'll touch on the robotics half in a little bit, but I think AI has advanced so much over this period of time. But if you zoom into just the last 5 years, something really special has been happening with the advent of generative AI. And it's in our view, a step function increase in the potential applications of artificial intelligence. What we traditionally thought of as areas of potential automation were robotics use cases in factories, basically automating manual labor. But with generative AI, what we see are the ability to automate knowledge work in a way that we didn't think was really possible before because we have this now base understanding of language and the way to model human thought using some of these cutting edge AI models from companies like OpenAI, Meta, Anthropic, et cetera. And just to set the stage here, if you look at this forecast, which is a survey of industry experts over the last 5 years, that's answering the question, or this question posed to those answering it is, when do you think we will have an artificially general intelligence system? And there's no consistent definition of this, but the definition used by the survey is a system in which you can speak to it for an hour or two and won't be able to tell that it's a robot and not a human. A system that is generally intelligent across many different types of standardized tests. I think we're almost largely there with some of the latest AI models acing tests well above the human average. And then lastly is a system that has very fine-tuned robotics capabilities such that it can assemble a model car. And I've looked at the instructions for this. It's actually a very difficult project that requires, let's say, sophisticated spatial reasoning. And if you ask this question to these experts 5 years ago, they said that it would take 80 years to achieve this capability. So this is something that's possible, but something that's possible by the end of this century. And since the launch of some of these technologies from OpenAI, GPT-3, ChatGPT, some of the newer models, what we've seen over time is that forecast consistently contract. So what we thought was possible in 80 years, the same group of experts now thinks is possible in just 8 years. So we've really gone from something that we thought was possible by the end of the century to the end of the decade, which really speaks to the pace at which this change is happening. That I think is catching a lot, even ourselves who live and breathe this every day, by surprise. And a lot of that's driven by cost declines. We try to measure in every technology that we invest in, what the cost decline rate is. We typically find cost declines very helpful to understand when a technology will be unlocking new pockets of demand and be able to thus scale to larger markets than the market anticipates. And the costs are falling in AI faster than almost anywhere we've seen previously. So the cost to train AI models is falling at 75% per year, and the cost to run AI models or inference AI models has been falling at 90% per year. So that literally means a workload that cost $100 to run last year now costs only $10. And this is really kind of the foundation for our understanding of how this compression of forecasts is happening and how these systems are continuing to get better. And the natural question on investors' minds is, all that technology stuff is great, but how do I get exposure? How do I invest in this opportunity? Because I think the opportunity is more and more apparent as we have, applications like ChatGPT that are some of the fastest growing applications of all time, and companies like Microsoft that are building it directly into the products that we use every day in the office. And I think we like to frame this as a spectrum or a value chain of opportunities in the AI space that range from the chips, the hardware that powers this new revolution, all the way through the clouds to the development platforms that we'll use to build AI use cases, to those end use cases themselves and what we call highly convergent applications. So these are areas where we combine AI with another technology, like robotics or energy storage, to do something really special, like the autonomous taxi network or humanoid robots. And I think where you can get a sense of where we are for the cycle, which is very focused on the left side of this diagram. Investment and revenue and value creation for sure in companies like NVIDIA that are really at the heart of this new computing paradigm, which is needed to power the next gen AI systems. But you're starting to see the value and revenue and market move to the right. So the clouds, for example, Amazon with AWS, Microsoft Azure, and Google Cloud have all seen reaccelerating revenues over the last year plus. And I think really where we're focused on investing in our portfolios is where the market's not looking at, which is what comes next, which are the AI development platforms that we'll use to build and deploy AI technologies. Palantir is a what we think is a very interesting and differentiated play in that space. And then the convergent opportunities like a Tesla, for example. And I'll spend some time just talking about Palantir because I'm not sure it's familiar to everybody, though it was just added to the S&P 500. So I'm sure it will be more familiar now than it would have been a year ago. But I would describe Palantir as providing a best-in-class data platform that allows you to take and aggregate data from many different enterprise systems and bring them together to drive insights from those data. But what's unique from Palantir is the ability to turn those insights into action because their platform is specifically designed to be able to write back to enterprise systems to take action on insights. And that's something that not every platform allows you to do. And in fact, if you wanted to do what Palantir offers, you typically have to string together several different traditional pieces of enterprise software, like a data warehouse from a company like Snowflake or from Amazon, a business intelligence tool from Tableau or Microsoft. An automation tool like UiPath, and then you have your enterprise SaaS applications like a Salesforce or an SAP. Palantir offers all of that in one cohesive package, and they make it extremely easy to build custom applications that integrate directly with AI models. So they've seen, particularly as every boardroom is scrambling to figure out their AI strategy, and CTOs and CIOs are being pressed on how to build AI applications for the enterprise. Palantir is seeing a lot of demand because they're really well positioned to enable this. So their US commercial business has been growing at 70% year on year on an adjusted basis for the last 3 quarters. And we think that's just one of several examples that are going to start to take off as the value accrual really moves across the spectrum from left to right. And that's what I think the market is starting to see. You've seen it with Palantir's performance this year, but I think we'll see it in other areas as well. And then if you're familiar with ARC, you know we talk a lot about Tesla, but all of these advancements and cost declines, we think only increase the likelihood of a autonomous driving achievement and a robo-taxi commercialization sooner rather than later, and certainly within our 5-year time horizon that we invest across our strategies. So let me double click on that kind of development platform category that you would call Palantir in, because I think it's particularly well positioned, not just as kind of this next slave of growth, but also with what we're seeing in AI that could disrupt the traditional world order in software. So if you look at the kind of cloud computing landscape, it's typically categorized into 3 or 4 layers. The foundational layer is infrastructure as a service. This is the raw compute and storage that companies like Amazon, Google, Microsoft provide and rent out, basically. The second is platform and infrastructure software. This is software used by developers, so a technical user base to actually build applications. And then you have those top of stack and enterprise applications themselves, like an SAP or a Salesforce. And what we're seeing with AI, one of the biggest applications that are driving real productivity gains today are coding assistants, which are quickly being called coding agents, which basically just means more capable assistants. And these agents are able to, what was in 2019, complete one line of code for you went from in 2022 completing one function or one file to now completing entire coding projects, more or less with the click of a button. So this capability is really inflecting, and we think will, at the margin, incentivize organizations who are always presented with a build versus buy decision. That buy decision is now looking relatively worse than the build decision because building is becoming cheaper. So that cost decline factors in here. And we think at the margin, companies are going to be more apt to build their own products, go straight to the development platform layer, use tools like Palantir, software development tools like GitLab, create more applications that need more security and monitoring, benefiting companies like CrowdStrike and Datadog. We think this is really well poised and well positioned here. Well, that top layer actually is facing potentially slower growth and disruption. You see companies like Klarna, which I think is a really interesting example, that have really embraced AI into their operating structure and are actually getting rid of their traditional enterprise systems of record. So getting rid of Salesforce, getting rid of Workday, replacing 700 customer service agents with AI models from OpenAI. This is, kind of early signs at just a few companies, but we think over the next 5 to 10 years, this is going to expand to pretty much all companies in every industry. I think it's as foundational as the internet, which we now see in every product and service we use and impacting every industry. It's not just one application of the internet, of course. And you actually already see this in the revenue growth of this segment, where the platform as a service and infrastructure software segments have been growing revenues at 31% on a compound annual rate over the last 5 years, which is the fastest of this cloud stack. So faster than applications and faster than infrastructure as a service. We always try to zoom out and think of what this means from a total addressable market perspective. And we think that a large part of this value accrual comes from, the case for the value comes from automating knowledge work or increasing the productivity of knowledge workers. There's about 1 billion knowledge workers globally, and their annual wages are about $30 trillion. And this is the kind of pool of labor, the pool of capital that's directly addressable by generative AI now. And that's why I went through this, talk at the beginning of how this has been such a shift. These are tasks that didn't seem like they were going to be automatable in the past, that now are in scope for automation. So we think that some portion of that capital is going to be moved from labor to software to increase the productivity of the working base. And we think that could be a multi-trillion-dollar opportunity by 2030. The current enterprise spend on software is about 1 trillion. So we think that could go, anywhere from 7 to 13 trillion by 2030, depending on how quickly this software is adopted. But I think it's much more, and this is where I'll get into kind of the convergence story. It's much more than just a knowledge worker story. There's implications of AI converging with other technologies that impact the rest of the world's employee base outside of knowledge workers, which are robotics. And I think this is a really interesting chart that always surprises me. This is work that our director of research for our autonomous mobility and robotics team, Sam Corris, has done, that shows that Amazon is on track in the next few years to employ more robots than humans, and they may already be there by 2024. We don't have the final numbers yet, but this number always surprises me, where the robotic capability has been increasing year on year, where the robots they use in distribution facilities, for example, can pick and place items. What was slower than humans, now faster than humans, and so they're rapidly increasing their investment there. But historically, and this is a cost decline story again, this technology is available to a company like Amazon, that's the biggest e-commerce and distribution company in the world. But the costs are too high, and the robotic needs too specialized to apply to companies downstream of or that are smaller than Amazon. And we think that we're seeing, kind of because of these cost declines in AI, the the opportunity opening up to smaller enterprises, and that's through humanoid robots. So we're already seeing some examples of this. Companies like Tesla are investing in humanoid robot capabilities. So are private companies in the AI space. One of them is partnered with OpenAI, and that we invest in our venture fund. And we think that if you look across both manufacturing opportunities, so working in factories, plus the automation opportunities in daily household tasks that we all spend time doing but are not paid for, this could each represent a $12 trillion total addressable market for humanoid robots. And this is a capability that we generally was believed to be a hardware problem, that we wouldn't have actuators that were precise enough. It turns out it's just a software problem. And if you have better software and better neural networks, you can make better use of the hardware that we have today. And that's, again, going back to the same foundational technology that's applying across all three of these domains, across knowledge work, household, and manufacturing. So we're extremely excited about kind of all of these opportunities that AI is catalyzing. So it may not seem like an elegant transition, but I'll just quickly go through some of our latest work on digital assets, because it is, of the innovation platforms that we research, the second biggest opportunity next to AI. And that's because, just like AI is foundational infrastructure for the next wave of computing, we think public blockchains are foundational infrastructure for the future of asset classes and for the future of finance. We again liken this to the internet, where the internet redefined traditional distribution channels for media, which were siloed and segmented. They became all internet native. We think public blockchains have the potential to take all traditional assets and make them on-chain or blockchain native. And in doing so, increase transparency, reduce fees, reduce the amount of friction that we see in financial services. And I think we've talked a lot about Bitcoin in the history of ARC's research, and for good reason. We think it's an amazing new form of non-government money, and we have a long history dating back to 2015 in owning that asset. But I'll just walk through stablecoins as another example of where we're seeing real adoption at some scale today that I think is surprising to many people. Stablecoins really are the blockchain version of a digital dollar that allow the settlement of value without the need for traditional payment networks like MasterCard or Visa. And if I asked you to guess before this presentation started, you probably wouldn't have guessed that the amount of value settled with stablecoins last year was larger than that of MasterCard. So $10 trillion versus 9 trillion for MasterCard. So this is a system that is moving money on the same scale of the largest payment networks that we have. The use cases, of course, are different than small everyday payments at coffee shops. But it shows that the technology is really ready. So as we have increasing regulation and institutional comfortability with this asset class, we think that will kind of grow as a use case over time. And it's something that we've even used at ARC to reduce fees and reduce friction when moving money through different accounts. And also, unstable international or hyperinflationary currencies is also creates high demand for stablecoins, where people who don't have access to U.S. bank accounts in the U.S. dollar can leverage the blockchain rails to get exposure. So, in summary, we think that smart contracts, as financial assets like tokenized dollars, like tokenized equity, like native crypto assets, move onto public blockchains, we'll see additional revenue generated from the companies that are living natively on blockchains, in the order of magnitude of $500 billion by 2030, which would create a $5 trillion market value. So with that, because I know we don't want to take up too much time, I will leave it for questions, and just saying that, like, reiterating, artificial intelligence and public blockchains are the two largest opportunities we see in our research, while robotics, while it is small today, we think could be the fastest growing now through 2030.
Thanks, Frank. That's awesome. Great presentation. Thank you. Quite a bit to think about there, and good to have a fresh face. It looked like Kathy was going to call you in the middle of that, in the middle of your presentation as well. So
She
maybe
did.
she's listened in. Hey, just a couple of questions. So I guess the sort of tech news of the last day or two was Mr. Zuckerberg and the new Orion glasses, and admittedly, obviously prototype still, but does that add to I guess the accumulation of data and the applications of AI going forward in whatever it is, 3 or 5 years when they become a commercial element?
Yeah, definitely. And the crazy thing is that they're here today. There's the Orion, the future generation with the holograms, but just the current generation of their glasses is really impressive. And I didn't wear them because I say Meta too much when I speak, but I have them here with the camera, and they're a little chunky, but they're actually quite good looking. And having a an AI assistant on your head is actually the hidden feature we didn't know we needed for smart glasses to actually make them cool instead of creepy. So we're particularly excited about Meta, not just from kind of the new hardware opportunities on the AR side and kind of embodied AI, but also on the kind of foundational AI capabilities, where they're really the only company that's open sourcing their models and is kind of going toe to toe with OpenAI and some of these other frontier AI research labs.
Yep. Well, they're pretty much on trend, that thicker look, and they're a bit in the news with, I don't remember the lady's name, but the person who walked through that secure area recording everything. So, hey, maybe I'll just change tact a little bit with Palantir. I mean, it's very interesting, and what you're saying resonated with us. Like, we use Salesforce, and the pain points of Salesforce in terms of getting it to actually do what you want. So that reach up into a business person, is that's effectively the use case when you start. They basically start gobbling the primarily the top part of those service platforms that sit above them on your presentation.
Yeah, exactly. And that's what they call it, the one size fits none problem of enterprise SaaS, where it's hard to get it to do what you want, and you need to pay consultants a lot of money to make it configured to what you want, and you better hope what you want doesn't change. So Palantir is much more malleable, and they're going directly after Salesforce is one example, but SAP is another example. They call it Project Warp Speed, but it's basically a new way to think about the operating system for manufacturing, not these like siloed chunks of software that don't connect well together. So yeah, we've demoed it ourselves, and I mentioned that I used to work with companies like Meta. Meta had the best data platform I've ever seen, and Palantir in many ways is very similar to it, and in some ways better. So I like to think of it as democratizing access to the data platforms of some of the largest tech companies in the world to every other enterprise.
Yeah, maybe just two related questions just to finish off your section. So, I guess when you look at Palantir, could you just talk about um, how the funds are positioned in it, and I guess the importance, if any, of I guess when you look at the board and the founders, we see, serial entrepreneurs, a good thing, in there, and how closely you follow people like Peter Thiel, for example.
Yeah, definitely. When Peter Thiel's been very successful, when so he has something to say, we definitely follow it. And he's had interesting comments in the AI space recently, talking about how NVIDIA has too much profit relative to the rest of the industry. So we pay attention, especially to Alex Karp as well. We factor into our kind of scoring process for a company, their people management and culture. And Palantir definitely checks the boxes with this leadership from really founders that are extremely passionate and have a very firm vision for where the company is headed and what value they add, which is what we like to see. And then also from the employee base, I remember when I was doing computer science in undergrad, Palantir was the hardest job to get. They hired some of the best engineers in the world, so they have this really deep engineering talent that runs through the company. So we love that from an analysis perspective. And then on in terms of fund positioning, you'll see Palantir in many of our strategies. It's one of the top 10 names in the disruptive innovation strategy, or ARKK. I don't know if you guys have access to ARKW, but it's in the top 10 as W as well. You won't see it as the number one or number three position because it is trading at quite a high multiple. So we take valuation into account here as well. So it's high up, but not number one for those reasons on balance.
Yep. Sorry, I might, because we're just on time, so I'll just maybe sneak one more team question in. Just in terms of, so when you're talking about stablecoin, I think, so that's a surprising graph in terms of the amount of, I guess, effectively settlements in old terms they've run over this period, and I had not heard of it. Notwithstanding, so it's not, is it, it's available for use potentially already at your local Starbucks, or is that not the case yet? Is it like how? how far and down the stack is it? Because it's doing obviously a lot
Yeah.
of big transactions, but how far down into everyday use is it now, and where might it get to?
Yeah, so you'll have a pretty hard time trying to pay at Starbucks with a stable coin,
Yep.
generally. So it's not widely available. The one means by which it is certain crypto exchanges like Coinbase and others will offer a kind of a card, a payment card in partnership with Visa, of all funny things, that will basically take crypto assets out of your Coinbase balance and use it to pay at a point of sale system that doesn't support crypto yet. And Visa actually is that bridge. So they're trying to integrate into this new world. So you won't see it directly. You will see it indirectly through those kind of using a traditional debit card as a bridge. But the actual rails to access it are quite easy. So if you could download any number of crypto wallets from the App Store and get access to a digital dollar, which is what's unique because not everybody around the world can get access to the US dollar just by downloading an app. It's much more tricky, of course. So that's part of the value proposition.
Okay. Yeah, I really enjoyed that. We could probably go for hours and days on this. So thanks very much for dialing in, and come and visit us down under. It's good down here. So anyway, I'll thank you, and we'll move on to Maisie. And I think if you're there, Maisie, then we're looking forward to hearing from you and what's been going on in the local market. And thanks for joining us again, Frank.
Yeah, thank you very much. Look forward to visiting soon.
Morena. My name is Maisie Ho, and I'm the research analyst in the equities team. I'll just get Rima, my colleague, to share my slides. There you go. Sweet. Okay. If we just go to agenda slides, sorry, Rima, which is the next slide. Great. Okay. So there's been a few big movements in the markets in September, and I thought I'll take you through some of the bigger ones, and I'll briefly then update you on the progress of our climate-related disclosure work and finish up with the performance of the funds. So on our next slide, first up, we have NextDC. On the 10th of September, NextDC announced a 550 million Australian dollars pro rata placement and a share payment plan of up to 200 million Australian dollars, which we participated in. And as we've heard from Frank earlier, the demand for AI is huge. At the back of this demand, there needs to be, data centers supporting it. So that's really NextDC's bread and butter. The catalyst for this capital raise is the advancement of their discussions with their internal discussions of their hyperscaling of their BTC model, which is, oh, hold on, sorry, I think it is BTS. It's a built to specification data model, and that's the route that they're going to go down further down track, building these data centers. Next one that we have there is on the 11th of September, Contact Energy entered into a conditional agreement to buy Manawa Energy via a combination of scrip and cash. The deal implies an acquisition price of $5.95 per Manawa share, which is 47.6% above its last closing price. So among other conditions, this deal is subjected to the approval of ComCom, so that's the Commerce Commission, and Contact Energy expects a decision in the first half of next calendar year, so we're just watching out there. And on my next slide, please. Go. As you all have probably heard, on the 15th of September, Auckland Airport announced the largest raise in NZX history to the amount of 1.4 billion. Well, now we participated at $6.95 a share, and this represents a 7% discount to the previous closing price. This raise will help sort out its balance sheet issues, and the amounts that they raised were quite surprising to some in the market. It just shows that Auckland Airport were being quite conservative in terms of what they needed or raised. The amounts raised will initially be used to reduce the debt, sitting at about 2.5 billion in the last results, and also to repay a 150 million bond maturity next month. It will then help fund its capital development program, which I'm sure a lot of us have heard about. And as expected, Auckland Council, which holds about 11% stake pre-raise, did not participate. And we are anticipating a big block of Auckland Council shares to be sold to the market in the near future as well. The next one there is this week on Monday, Fletcher Building announced a $700 million raise at $2.40 a share. This is a large 17% discount to where it last traded, or adjusted for the dilution of the capital raise, about a 13% discount. The raise was to strengthen its balance sheet and to improve its financial stability. As we all know, the construction sector is not doing very well. Same with consumer discretionary because of the macro environment. It also reduces short-term pressure on Fletcher's to sell their assets to improve its balance sheet. Now, there was no change to its outlook statements, with July and August trading volumes and material and distribution down 10 to 15%, and their residential and development also down materially on last year. The new CEO is just starting, so this just enables him to come into the business, not worry about the balance sheet, focus on operational performance, which actually brings me to my next slide on management changes in the market. So the new CEO of Fletcher Building is Andrew Redding. He has had a history with Fletcher's. He commenced as a director on the 22nd of August and will assume the role of Group CEO and Managing Director from the 30th of September, so that's next Monday. During his previous time in Fletcher Building, he held roles of CEO of Building Products and Steel from 2001 to 2006, and the Managing Director of Fletcher Woods Panels from 97 to 2001. On top of this, Fletchers have also appointed a new CFO, Will Wright. He comes from Somerset, but he does also have a previous history with Fletchers. So prior to joining Somerset in 2021, he spent about 7 years at Fletcher Building, including the roles of CFO and the Residential and Development Division, the GM Group Strategy, and the CFO of the Building Products Division. So they've got two kind of people on the helm there that have a huge history with Fletchers there. Fletchers are yet to complete their executive puzzle. They are still looking for the chair of the board, so that's something that we will be keeping an eye on as well. Lastly, on market movements and management changes there, Ryman Healthcare has appointed Naomi James as his new CEO. We know Naomi very well. She is a former CEO of Channel Infrastructure, where she successfully managed what was the New Zealand refinery from being a refiner to importing fuel and what is an infrastructure provider now called Channel Infrastructure. She will be based out of Sydney at this stage, which we find a bit curious, and will form part of our engagement questions when we meet the board soon, I think in the next couple of weeks. Cool. Okay, we'll just change tack for now on our next slide. We've just published our climate-related disclosures. I've spoken to a few of our clients as well about this and answered some questions. So feel free to reach out if you want a copy. We're happy to send it through. These disclosures are intended or were written for the retail clients. However, our retail funds do flow into our wholesale funds, so it should be useful for everyone that is interested. It can also be found in the company's office, but like I said, feel free to reach out and we can send a copy to you as well. Thought I'll share a few things about what we've learnt from the experience, what was good, what was bad. A large part of the disclosure is how we assess risk and opportunities of our funds. Now, we've always done this in our investment process, and climate-related opportunities and risks just kind of form part of our risk assessment, basically, on top of or right up there with your liquidity risk or your management risk, those type of stuff. The climate regime, however, have formalized this a little bit more. We're required to document a lot more and obviously produce the statement. The scenario analysis part of things also allowed us to view our portfolio with a different lens, which includes assumptions that make up the orderly, hothouse, and too little, too late scenarios. So those are the scenarios that align with 1.5, more than 2 degrees, and more than 3 degrees scenario. And there's a whole lot of assumptions that go into there. So it's important to remember that these are just scenarios, they're not forecast. And we layer this on top of our portfolio funds. And it provides us with a starting point and a good discussion point for when we engage with our investee companies as well. So that's all the good stuff. There has been definitely, challenges, some expected and unexpected as well. A recurring theme that we found when we check in with our peers and engage with our investee companies is that this is a very timely and costly exercise. We think it's important to try and balance, your money and resource needed for the disclosure with what the climate statements are actually intended to do, which is to improve climate action. The whole regime is also a barrier on listing the stock exchange, especially if you are a smaller company with limited resources. We have surveyed a lot of our investee companies, and the amount of money that they are spending is just prohibitive to smaller companies actually needing to spend this when they do have to disclose. As fund managers, we report on a fund-by-fund basis and are therefore reliant on our investee companies' reporting. So data is a big issue for us. So we have to depend on assumptions and methods. Number one, on the investee companies, what they're using, what standards they're following. And we also have to rely on data quality from our third-party providers, such as MSCI, Sustainalytics, ISS, and so on. We are by no means climate deniers and take climate risk and opportunities seriously. However, these data issues do present us with an awkward question of whether we and, more generally, other fund managers and asset owners would pass an audit, which is compulsory today, but from the 31st of December reporting period onwards. So in the background, we're working with the XRB, FMA, and we've even written to the Minister of Commerce on this issue about the possibility of extending the audit requirement, at least for fund managers, because the data sets is not good enough on the back, and possibly making it in line with Australia's reporting assurance requirements. The XRB has also put out a statement a couple of days ago, and they will be putting out consultations soon on some of these possible exemptions or delay. So watch out for that consultation. It is a short one. It's only 2 weeks. So if you want to discuss or have a chat on that, let us know. And next slide. So lastly, this is the performance of our funds. Month to date, our core concentrated SRI fund are ahead. They range between 35 points to 65 points. The concentrated benchmark there is not actually the NZX 50, but we like to put it there just as an easy reference. Our year-to-date number are all ahead as well. We've just got the prelim numbers there, so I didn't want to put up those numbers yet. And that's me. Back to you, Stu.
Thanks, Maisie. Great presentation as always. Just because we're in a public forum, I should thank you publicly for the work you're doing. I've done with climate reporting, but also the work that's going on in terms of trying to potentially adjust what's going to happen with climate reporting via XRB and FMA and all that sort of thing. That is as recent as yesterday that we were working on that. Also interesting, just off screen, I was just having a look at the Fletcher's board, and I guess the good thing about the Fletcher's board is the most recent appointments have deep have deep building experience. So we're looking forward, as you said, to the refresh and change in leadership there, because it has been something of a challenge. And yeah, it's that's I think I haven't had any questions come through for you, which is good. Everyone, we might give you back some time on your Friday, and yeah, if you're heading off on school holidays and all that sort of stuff, then 15 minutes will be valuable. And thank you very much for your support, and we will see you next time, just ahead of the American election. Thank you all.
Thanks, guys.